Hello everybody, welcome to Trust Fund Tuesdays. This is CEO of Culture Shock Investments here with you, Michael Clark, and I'm here to talk to you about bonds this week. Boring, go to sleep, bonds, right? No, bonds are very exciting, especially in a market like right now when everything else is not so exciting. You want to go ahead and look in the bond market. We're going to look at particularly the U.S. savings bond market because the bond market has various different bonds, and I'll make sure to touch on each one of those for you. But we're going to start with U.S. savings bonds, and the two main bonds in that market are the Series I bond and the Series EE bond. Now, these two bonds are going to be differentiating themselves by a single major factor, I want to say. Is that the Series I bond is going to be the bond that keeps pace with inflation. So a Series I bond will be giving you an 8% yield right now because inflation is at 8%. A Series EE bond provides a fixed rate of yield compounded on an annual basis. Now, that's a major difference, the compounding and the inflation. Those are the two tools that are major aspects of both. So the Series EE is using compound and Series I is using inflation as its enticement tool to get you to purchase it. Now the Series I bond does have a fixed rate underneath it, but that fixed rate does not compound like the Series EE bond does. So the Series EE bond essentially gives you like a 0.1% interest rate. At some point in time, they did have some at 1%. I wish I got some then. But right now it's at like 0.1%. And that compounds semi-annually, which means about every year you're going to end up with about 1.2% in interest by the end of the year on whatever the bond is. So if you bought a $100 bond, that may be like $101.02 by the end of the year with the Series EE. But with the Series I, with how high inflation is this year, if you paid $100 for a bond, you'll have $108 because inflation is at 8%. So you see that's a vast difference, and we're talking about $100 there, but when you start talking about thousands, 10,000s, and millions, that difference becomes larger and larger. So that is the vast contrast between the two, but both are great for long-term investments because after 20 years of holding these bonds, like most bonds, the U.S. government is guaranteeing to double the value of the bond that you bought. So if you bought that $100 bond today, in 20 years that bond will be worth $200. And that's guaranteed. No matter where inflation went, no matter how steady the rate of the EE bond was, if it didn't reach $200, they're going to make sure they cover the gap and secure you that $200 for giving them that bond 20 years ago. All right, so we're going to move on next week. I'll see you guys soon.